Okay, let's continue with some exercises out of Chapter 2. Number 7 reads, Innovative Consulting Company has the following accounts, and they give you a whole list of accounts there, and then it says, journalize the following selected transactions. And as you read in the reading, there's always a debit and one credit for every transaction, at least one debit and one credit. Now you can have several debits and only one credit, or one debit and several credits, but the transaction needs to balance. So I'm just going to go through the list here of October 1st to the 31st. We are going to do many journal entries here, not only in this exercise, but throughout this chapter and the next. And practice is what will have this finally sink in. So just bear along and we shall get through this. Paid rent for $2,500, so debit rent expense, credit cash. Paid advertising expense, again another expense for $1,000, and they said paid, so that's a credit to cash. The 5th, paid cash for supplies, so that's actually going to go to a balance sheet asset account because we're going to debit supplies and credit cash. Purchased office equipment on account, and that's where we get accounts payable. It's on account. We charged it, and we're going to debit the office equipment. Received cash. Okay, so now we're going to debit cash, so cash goes up, and accounts receivable goes down, and that's why we credit accounts receivable. So it was initially debited way back when they sold something to a customer, and they debited accounts receivable and credited some kind of revenue account, but they didn't pay for it. They just charged it, but we did a sale, and now they are paying us back. So we reduce the receivable and debit cash. Paid a creditor on account. Now this would be like the flip side of number 12. We are paying the cash on something that we charged. On the 27th, we paid cash for some more miscellaneous expenses, debit expense, credit cash. On the 30th, we paid a telephone bill, so we debit utilities expense and credit cash. The 31st, fees earned and billed. So this would go like this one right up here that we talked about. We earned it, so we're going to debit our revenue account. They didn't pay us, so we debit a receivable. Until they pay us, we debit a receivable. The 31st, again, an electricity bill, a debit to an expense, credit cash. And the last one, we paid dividends, credit cash, and debit the dividends. Exercise number 9, the following selected transactions were completed during July. And it says here, do the journal entries for number 9. All right, so billed customers for fees. Again, we billed them because they didn't pay us. We earned the fees, so we debit AR. Number 2, purchase supplies on account. Debit the asset and credit the payable because we didn't pay for it. Received cash. Now we debit cash and we reduce that receivable. They have now paid us. And then we paid creditors that we had once charged. So now we reduce, we debit the payable, and we credit cash. It also asks in letter B to put those into T accounts, and you saw that in your reading. So cash, that normally has a debit balance. Accounts payable has a credit balance. Supplies always has a debit balance. Fees earned has a normal credit balance, and AR has a normal debit balance. So in this case, for transaction number 1, you notice how we debited an AR and we credited the fees. So we go to the AR, we debit the AR, and we credit the fees earned. As you noticed in the reading, any account, the left-hand side is always the debit, and the right-hand side is always the credit. You may say, well, there's not an R in the word debit. Why is he using the word R? And I can't answer that for you other than for as long as I've done accounting, the abbreviation for debit has always been DR. And I am about as old as dirt, So if that's the way it's been, that's probably the way it will continue to be. Debit is a DR. So that takes care of number 9. Number 13, it asks, or goes on to read, Rocky Mountain is a travel agency. The 9 transactions recorded by Rocky Mountain in the first month are as follows. Indicate for each debit and each credit whether it was an asset, liability, equity, dividend, revenue, expense account that was affected. And letter B, whether the account was increased or decreased. Okay, so if we go to number 13, well, what we're going to do here is let's look at first transaction number 1. And remember, every transaction has to balance, so there has to be at least one debit, one credit, but the sum of those debits and the sum of those credits have to balance. So for number 1, there was a debit to cash for $40,000, so we're just going to put cash for 40. And then there has to be at least a credit, entry number 1, yes, to common stock for 40 grand. So, and that's what you see right here in exercise number 14. So they debited cash, they credited common stock, and we increased cash because cash is normally, it's an asset, has a normal debit balance, so increased it. Common stock is an equity item. It normally is a credit balance, so it also increased. Entry number 2, there's a debit to supplies and a credit to cash. So supplies went up, an asset went up, and an asset went down. All right, cash is a normal debit balance, so it went down. Entry number 3 is what we call a compound entry, where there's one debit but 2 credits, but they balance. Equipment is an asset, debit, increase. Accounts payable, we charged it, so accounts payable is going up, but our cash asset is going down. So you see here, asset is going down, but the liability account is going up. Expense is normally a debit. Expenses are going up, cash credit going, assets going down. Receivable, debit, increase. Revenue, credit, increase. Accounts payable, normally at credit, so we're reducing the payable. We're reducing the payable, the liability, and we're reducing cash, reducing our asset. Cash going up, AR going down. So that means somebody's paying down what they owed us. That asset is going down. Here again, expenses are going up, but the asset is going down. They are now using those supplies. And then, of course, dividends increased, and the asset, the cash account, went down. And then there was number 15, and it said prepare a trial balance. Prepare a trial balance. Excuse me. Well, the only way you could do a trial balance is first by creating all those T accounts for every account. And let's just say the first one is cash. And you put all your debits in there and all your credits. And then ultimately, at some point, you're going to get an ending balance. It should be a debit. You can never have a negative cash account, right? It's not supposed to. So then you would say, well, that's the balance, the debit side, and you would put that here, $30,425. Now, in this assignment, we did not need to put all the debits and the credits in. However, it's already provided to you in the textbook. Excuse me. So if you looked at the cash account that's in your text and you added all the debits, took away all the credits, your balance would have been $30,425. Equipment. You notice there's only a balance of $15,000. So there is your $15,000. What's the point of the trial balance? There's only 1 point. 2 points. It lists all of your accounts that you have, as well as it shows your debits equal your credits. That's the gist of a trial balance. It lists all your accounts, and it shows the reader they balance. So that's basically number 15, and it also 13, 14, and 15 really all work together. And I would tell you, those 3 exercises put together, it's a really good review and make sure that we have a good understanding of why an account's going up or going down. Is it a debit? Is it a credit or whatever? In letter B, it says, what's the net income? Well, then all we're doing here is we're taking all of our revenues, $20,500, it's only one, less all of our expenses. There's only one expense. So our net income is $12,125. What to remember? Dividends is never an expense. It looks like, it acts like, and it smells like an expense, but it's not. That's why it's in the retained earnings section, because it's a reduction of equity. It is not an expense. Revenues minus expenses. We'll stop there for a moment